So we're going to swap out our teams and bringing another topic. Our liabilities and equity team. Ready? Erica, let me turn it over to you. Good morning.
Okay. Good morning, everyone. Today, we'll ask the board whether it would like to add a project to its technical agenda on debt and equity in response to recent feedback we've received from stakeholders, including feedback that we received through the 2025 invitation to comment agenda consultation or 2025 ITC that we'll refer to it as. So we'll first tee up questions 1 through 3 in the board handout related to the agenda decision. And if the board adds a project, we'll right after ask the board about which areas the guidance it would like to include in the project scope and any feedback on the recommended project objective. This will include a high-level overview of current gap and 2025 ITC feedback and the staff's research, analysis, and recommendations on the 3 key areas of the guidance, the indexation and equity classification guidance in subtopic 81540 and the distinguishing liabilities from equity guidance in topic 480. If the board adds a project to its technical agenda with a scope that includes the indexation guidance in subtopic 81540, we'll then ask the board questions 4 to 5 related to which the approach of improving indexation the board prefers, and if the board has any feedback on the staff's planned next steps. And so I'll now turn it over to Eric, who will give you a high-level overview of current gap and the 2025 ITC feedback.
Thanks, Erica, and good morning, everyone. I will now give a high-level overview of the current gap in ITC feedback. When an entity issues an instrument to obtain financing, such as a warrant, that has a settlement amount based on the entity's own stock and that is settlable in the entity's own stock, it must determine whether the instrument should be classified as a liability or as equity. That determination includes evaluating whether the instrument is required to be accounted for as a derivative in accordance with topic 815. The outcome of that analysis affects the instrument's accounting treatment, which includes whether changes in the fair value of that instrument is recognized in net income and what disclosures are required. However, this type of instrument often has characteristics of both liabilities and equity, which can make this determination complex and challenging. Subtopic 81510, subtopic 81540, and topic 480 are the primary areas of gap that an entity applies to determine the classification and accounting treatment for these financing instruments. In gap today, there's a scope exception from derivative accounting for contracts that are indexed to an entity's own stock. The analysis to determine whether the contract meets the scope exception is included in subtopic 81540 and is a 2-step process. First, the contract must be indexed to the entity's own stock, which is referred to as the indexation criterion in section 81540.15. And secondly, the contract must be equity classified, which is referred to as the equity classification criterion or settlement criterion in section 81540.25. If a freestanding financial instrument meets the derivative scope exception, it would be equity classified and not remeasured. If it fails either of the criterion in subtopic 81540, the contract would be asset or liability classified and could be accounted for as a derivative. The instrument would be remeasured at fair value through net income every period. If an embedded feature fails a derivative scope exception, it would have to be bifurcated from the host contract. Over the last decade, the FASB has undertaken several projects to improve the accounting in this area, but there have been challenges in making broader changes due to differing stakeholder views about financial reporting outcomes and generally a resistance to make significant changes. However, in recent years, the board has been successful in reducing the cost and complexity of applying the liabilities and equity guidance through targeted improvements such as ASU 2711 and ASU 2020-06. Most notably, ASU 2020-06 impacted subtopic 81540 by removing several additional conditions required for equity classification. Lastly, to summarize 2025 ITC feedback from a high level, liabilities and equity received the 5th highest volume of feedback with 31 stakeholder responses. Stakeholders emphasize that the guidance in subtopic 81540 continues to be complex and costly to apply. They observe that this guidance is a frequent source of financial statement restatements because it's difficult to understand and often results in conclusions that appear to be more form over substance. Furthermore, almost all stakeholders that were in support of the board adding a project to its technical agenda on liabilities and equity noted that they support changes that would lead to more equity classified contracts. For a more detailed breakdown of the 2025 ITC feedback, see Appendix A of the board meeting handout. Now I will pass it to Katrina, who will go into more depth on the indexation guidance in section 815.40.15.
Thanks, Eric. So like Eric mentioned, I'll provide a summary of the current indexation guidance that's in section 815.40.15, and I'll provide a summary of the feedback that we received on that topic and the staff's analysis of the agenda decision criteria related to indexation. So the analysis of whether a contract is indexed to an entity's own stock, so whether it meets the indexation criterion, is a two-step process. Under step 1, an entity is required to evaluate the contract's contingent exercise provisions, if any. And then under step 2, an entity is required to evaluate the contract's settlement provisions, that is, under the settlement amount. And step 1 and step 2 must both be met in order for a contract to meet the indexation criterion. For step 1, analyzing contingent exercise provisions involves determining whether the contingency is based on something related to the issuer. And under step 2, analyzing a contract settlement provisions involves determining whether the settlement amount is fixed, and if not, whether the variables that could affect the settlement amount would be inputs to the fair value of a fixed for fixed forward or option on equity shares, and that's known as the fixed for fixed assessment. Just as an example, an issued share option that gives the counterparty a right to buy a fixed number of the entity's shares for a fixed price is considered indexed to the entity's own stock. However, an instrument is not considered indexed if its settlement amount is affected by variables that are extraneous to the pricing of a fixed for fixed option or forward contract on equity shares. The staff performed outreach throughout 2025 and early 2026 related to the indexation guidance and also received feedback on this topic as part of the 2025 ITC. And the staff observed several key takeaways from that feedback. First, the current guidance and outcomes are unintuitive. So as a result, there's diversity in practice, and the guidance in step 2 of the indexation guidance is applied inconsistently. Practitioners today are having a hard time explaining to their clients why certain contracts are not allowed to be recorded in equity because of features that an entity may believe are either remote of occurring or are tied solely to its own operations and activities. Second, improvements to step 2 of the indexation guidance should be prioritized. Among the liabilities and equity guidance, including subtopic 815.40 and topic 480, step 2 of the indexation guidance and the fixed for fixed assessment are the primary areas that practitioners struggle with because they continue to be complex and costly to apply, and therefore stakeholders noted that the board should prioritize indexation at this time. Third, introducing probability may not reduce complexity. So, although practitioners noted that adjustments that are unlikely to occur should not drive classification, incorporating a probability threshold into step 2, such as probable, may not actually address current practice issues or reduce complexity, but rather layer on more complexity onto an already complex model. And lastly, distinguishing between acceptable and non-acceptable leverage factors is challenging. So there are diversity in views and practice among practitioners about what are leverage factors and to what extent leverage factors should preclude indexation. Many noted that identifying what is and is not acceptable would be challenging and could create complexity and judgment that would either retain or increase inconsistency in application of the guidance. So to assist the board in making an agenda decision, the staff has analyzed the board's agenda decision criteria for a project on the indexation guidance in subtopic 815.40. So as it relates to the first criterion, whether there is an identifiable and sufficiently pervasive need to improve GAAP, in the 2025 ITC, distinguishing liabilities from equity received the 5th highest volume of feedback of the 42 projects or topics, with most of the feedback received from practitioners. In addition, stakeholders have identified a pressing and pervasive need for improvements to the indexation guidance in section 815.40.15. And in addition, stakeholders did identify several challenges with current GAAP that I mentioned previously. Those challenges identified by stakeholders affect any entity, public or private, that holds a freestanding financial instrument or embedded feature. Overall, the staff thinks there is an identifiable and sufficiently pervasive need to improve the indexation guidance, particularly step 2. And the staff is unaware of significant challenges in applying step 1. It does not think there's an identifiable and sufficiently pervasive need to improve step 1 at this time. As it relates to the second criterion, whether there are technically feasible solutions and our expected benefits of those solutions are likely to justify the expected costs of change, the staff has identified several potential approaches to improving indexation that it believes are operable and auditable and would be an improvement to the current indexation guidance. Those approaches are included in paragraph 19 of the board meeting handout. The staff thinks that each of the approaches address current practice issues in varying degrees and have different expected benefits and costs. If the board does decide to add a project to its technical agenda on the indexation criterion, we'll discuss these approaches in more detail at that time. And in considering previous and recent investor outreach, investors do not generally find fair value changes of liability classified equity instruments that are included in net income to be decision useful. And the approaches that the staff has identified are intended to increase the number of equity classified instruments, which would reduce this income statement effect and potentially benefit investors. Investors generally said that disclosures of the term and features of equity instruments are more useful to them in their analyses than the classification. And as part of Update 2020-06, investors indicated that they received sufficient information about contracts and entities owned equity. So with any of these approaches, the staff plans to ensure that the decision usefulness of information that's provided to investors is not reduced and that the sufficient information continues to be provided to them. And as it relates to the third criterion, whether there is an identifiable scope, the staff thinks that there is an identifiable scope to improve the indexation guidance because 81540-15 has an established scope and the staff is not aware of any significant challenges in applying that scope. So the staff does recommend that the board add a project to its technical agenda to improve step 2 of the indexation guidance in subtopic 81540, including the related disclosures. So I'll now pass it over to Chris, who's going to take us through equity classification.
Thanks, Katrina. As Katrina mentioned, I'm going to cover the equity classification guidance, which refers to the guidance in section 81540-25. An underlying premise of this guidance is that contracts that require settlement in shares or provide the issuer with the choice to settle in net cash or shares are equity instruments, while contracts that require net cash settlement or give the counterparty the choice of cash or share settlement are assets or liabilities. The guidance generally does not permit considering the likelihood of a cash settlement event. Therefore, it's possible that an instrument could fail to be equity classified due solely to the existence of a feature that requires net cash settlement in a remote scenario. Because this guidance is premised on the ability of the issuer to settle a contract in shares, there are also several conditions that must be met for an instrument to be equity classified. For example, an issuer must have sufficient authorized and unissued shares to equity settle the contract. Those conditions were simplified by the amendments in Update 2020-06. Separately, the SEC requires that issuers distinguish certain redeemable equity instruments from permanent equity. Guidance from the SEC and SEC staff on the accounting for certain redeemable equity instruments has been codified for convenience in section 480.10 S99. I'll refer to this as the temporary equity guidance. That guidance includes both SEC Accounting Series Release 268, which was incorporated into Regulation SX, and related SEC staff positions. Instruments that are in scope of this guidance may be required to be classified as temporary or mezzanine equity, which is a category between liabilities and permanent equity. That highlights the potential of those instruments for cash redemption. A couple of other quick notes on the temporary equity guidance. The subsequent measurement requirements under this guidance can vary depending on whether an instrument is currently redeemable or is probable of becoming redeemable. Next, we note that there's specialized EPS guidance for instruments in this category. And finally, some have noted that they believe it is unclear how the changes made to the equity classification guidance in Update 2020-06 affects or doesn't affect the application of the temporary equity guidance, including whether the temporary equity guidance would apply to certain freestanding equity classified instruments. So with that as background, I'm going to switch gears to focus on the stakeholder feedback that was received on this issue. In response to the 2025 ITC, about half of the stakeholders that identified liabilities and equity as a top priority noted that the equity classification guidance should be prioritized. For example, a few practitioners said that the current guidance prevents an entity from evaluating the likelihood that a contingent event would trigger cash settlement, which can result in outcomes that are counterintuitive. Stakeholders suggested several ways to improve this guidance. Some recommended introducing a threshold into the evaluation. For example, for contracts with net cash settlement provisions that are triggered only by contingent events, such as a fundamental transaction, some proposed using a probability or trigger-based approach that would disregard those provisions until the event becomes probable or is actually triggered. Some feedback also suggested eliminating the additional conditions necessary for equity classification. By contrast, some stakeholders did not support prioritizing changes to the equity classification guidance at this time. They noted that following the simplifications in Update 2020-06, challenges in applying the equity classification guidance have decreased. Others emphasize that if the board undertakes a project in this area, it should more holistically consider other similar areas of gap, such as Topic 480 on distinguishing liabilities from equity and the temporary equity requirements. Some stakeholders also observed that any changes to the equity classification guidance in subtopic 1540 might have a limited effect for public companies because they believe the temporary equity guidance might continue to apply. Separately, the staff conducted outreach with practitioners on this issue last year alongside its outreach on indexation. Practitioners provided feedback on the relative importance of addressing the equity classification guidance that was generally consistent with the 2025 ITC feedback, including that it was not as high of a priority as improving the indexation guidance. Although the staff was asked about a probability-based approach for equity classification similar to those proposed in the comment letters, practitioners raised concerns about both evaluating probability and the added complexity that such an approach could introduce, including the risk that more instruments would fall into temporary equity. Based on that feedback, the staff evaluated this issue against the board's agenda decision criteria. Although liability classification that's driven solely by remote cash settlement provisions represents an identifiable issue, recent feedback was mixed about whether the need to improve gap in this area is sufficiently pervasive and whether this issue should be prioritized at this time. In evaluating whether there are technically feasible solutions whose benefits would justify the cost of change, the staff analyzed probability and trigger-based approaches. It also analyzed revising or eliminating the additional conditions necessary for equity classification. We considered that absent concurrent changes to the temporary equity guidance, simplifying the equity classification guidance in subtopic 1540 might not alone resolve current practice challenges. Instead, if more instruments are equity classified, it might simply shift complexity from the subtopic 1540 guidance to the temporary equity guidance based on our understanding of current practice. It might also contribute to uncertainty about how the equity classification guidance and the scope of the temporary equity guidance interact. In terms of a potential project scope, the staff observed that any changes to subtopic 1540 that are not aligned with the guidance in topic 480 or topic 718 could raise broader questions about whether those areas should be addressed simultaneously. Several stakeholders also cautioned that amendments to subtopic 1540 should not be pursued without considering the implications for the temporary equity guidance. On the basis of this analysis, the staff does not recommend adding a project to the technical agenda to revise the equity classification guidance in subtopic 1540 at this time. And with that, I'll pass it off to Okan to discuss topic 480.
Thanks, Chris, and good morning, everyone. I will now provide an overview of the topic 480 guidance and the staff's research and analysis. Topic 480 provides guidance on how an issuer should classify and measure freestanding financial instruments with characteristics of both liabilities and equity. Specifically, Section 480.10.25 requires that an issuer classify a financial instrument that is within its scope as a liability or an asset in some circumstances because that financial instrument embodies an obligation of the issuer. If an entity evaluates an instrument under Topic 480 and concludes that it is not required to be accounted for as a liability, it must then evaluate the guidance in subtopic 8.1540 to determine whether it must be classified as a liability or an equity. In this way, an entity cannot conclude under Topic 480 that an instrument can be equity classified because Topic 480 only provides guidance for certain financial instruments that are required to be liability classified. Topic 480 requires liability classification for 3 classes of freestanding financial instruments. Number 1, mandatorily redeemable financial instruments. Number 2, obligations to repurchase an issuer's equity shares by transferring assets. And number 3, certain obligations to issue a variable number of shares when the monetary value is either predominantly fixed, varies with something other than the fair value of the issuer's stock, or varies inversely to the issuer's stock. Next, I will discuss stakeholder feedback pertaining to Topic 480 that was received as part of the 2025 ITC. Of the stakeholders that identified liabilities and equity as a top priority as part of the 2025 ITC, many noted that the board should consider comprehensively reviewing and updating the liabilities and equity guidance, which would consider an evaluation of the guidance in both Topic 480 and Subtopic 81540 and potentially aligning those models. However, stakeholders were divided on whether a comprehensive framework should be pursued in addition to targeted improvements to Subtopic 81540, instead of targeted improvements, or at all. Stakeholder views from the 2025 ITC generally fell into one of the following categories. First, some stakeholders preferred a long-term comprehensive project along with short-term targeted improvements to the indexation guidance in Subtopic 81540. Second, other stakeholders primarily preferred developing a comprehensive framework. And third, some stakeholders preferred only targeted improvements, and certain stakeholders warned that there could be unintended consequences if a comprehensive project is pursued. Therefore, based on the feedback received, the staff evaluated this issue against the board's agenda decision criteria. First, the staff notes that the inconsistencies in guidance and accounting outcomes between Topic 480 and Subtopic 81540 could represent an identifiable issue. However, stakeholders did not generally identify any significant issues related to the application of the guidance in Topic 480, and the staff does not believe there is a sufficiently pervasive need to change the guidance in Topic 480. Second, in identifying whether there are feasible solutions, the staff considered the board's recent attempt to amend Topic 480 in the Liabilities and Equity Phase 2 project, which was deprioritized in 2022. During that project, the board attempted to improve and align the indexation guidance in Topic 480 and Subtopic 81540 to reduce inconsistencies across GAAP. The board and staff explored several solutions to accomplish this objective, including both qualitative and quantitative thresholds and principles, none of which were broadly supported by stakeholders because of viability concerns or because the approaches would have too significantly changed current accounting outcomes. Therefore, at that time, the staff and some board members questioned whether there are technically feasible solutions to align the guidance between Topic 480 and Subtopic 81540, in which the expected benefits would justify the expected costs of change. Based on this recent attempt and feedback received as part of the 2025 ITC, the staff continues to question whether there are technically feasible solutions in which the expected benefits justify the costs. Lastly, the staff does think that there would be an identifiable scope to improve the distinguishing liabilities from equity guidance because Topic 480 has an established scope, and the staff is not aware of any significant challenges in applying that scope. Overall, the staff does not recommend adding a project to address the distinguishing liabilities from equity guidance in Topic 480 at this time. Now I will hand it over to Edward, who will provide a summary of the staff's analysis and recommendations.
Thanks, Okan. In summary, although there have been varied suggestions of what scope, objective, and solutions the board should consider, one message has been clear through all of the feedback, including from private companies. There is a sufficiently pervasive and pressing need to address the indexation guidance in Section 81540-15, particularly Step 2 of the indexation guidance. Therefore, the staff thinks that all of the agenda decision criteria are met, and we recommend that the board add a project to its technical agenda to address Step 2 of the indexation guidance with the objective to make the guidance less complex to apply and understand, and reduce inconsistent interpretation and application of the guidance. When the board attempted to change the indexation guidance in the past, it encountered challenges in identifying feasible solutions and resistance to change any accounting outcomes. However, as a result of several rounds of practitioner outreach and the development of various approaches, the staff believes that the board will be able to overcome those challenges at this time because A, it has identified a technically feasible solution in which the expected benefits would justify the expected costs, and B, the feedback received as part of the 2025 ITC and recent outreach indicates that stakeholders would support accounting for more contracts as equity as compared with today, which represents a significant shift in stakeholders' views from previous attempts to change the indexation guidance. Alternatively, the staff does not recommend that the board add a project to its technical agenda related to the equity classification guidance in section 815-4025 or topic 480 at this time. Although there may be identifiable issues, the challenges around the indexation guidance represent a more pressing and pervasive need at this time, and the staff believes that the board will be most successful with a narrow scope focus on indexation. And with that, I'll hand it back to Rich to open up discussion on questions 1 through 3 in the handout.
Well, great. Thanks, team. That great tee up. Very comprehensive. Any questions for the staff on questions 1 through 3 before I turn it over to the board? All right, not seeing any. Sue, may I start with you?
Sure. So appreciate that comprehensive tee up and bringing it home, Edward. I think that certainly this is an area where we continue to get a lot of feedback. And I think that the incremental outreach that the staff has done since the last time we considered indexation particularly has been helpful and at least for me in identifying whether we have potential solutions that could solve the problem. So certainly I was one of those ones around last time, I'm sure you're tired of me saying this, that would have supported continuing to pursue a solution for indexation. So not surprisingly, I am supportive of adding a project to the agenda and focusing on indexation. I think that it represents the area where we've gotten the highest amount of feedback on the need to prioritize. I think it represents something that's achievable because I think you have done the work to identify some solutions that could potentially work. And I think, certainly it acknowledges our previous attempts and leverages those attempts to understand that maybe what we did in the past or what we proposed in the past wasn't completely operable. So I think that we've learned a lot from this process. And so with all that said, I would support adding a project on indexation. I wouldn't support the other projects. I agree with the staff's recommendation, particularly as relates to equity classification guidance in topic 480. But I wouldn't in the future rule that out as an area, particularly equity classification, where we might be able to streamline it or maybe do something a little more broadly on topic 480. But I do see that as a longer term, more comprehensive project. On question 3, as it relates to the project objective, I think you included some things in the board memo on that, and I was particularly focused on what you had as A and B, which is reducing complexity and improving consistency, and maybe turn the negative into a positive. I would focus on those 2 as the objective.
Thanks, Sue. Joyce?
Thanks, Rich. So first, I'd like to thank the ITC respondents for their very informative comments around this topic, and certainly the staff for distilling them, providing research and analysis to propose these recommendations today. Hybrid capital instruments are so complex with the multiple contingent provisions that they encompass, and it simply makes economic analysis very difficult when you layer on the multi-layered accounting assessments and screens that we have in our guidance. It makes it even more complex for preparers, for practitioners, and investors alike as they try to appropriately account for these instruments and the claims that they may represent on the resources of the organization, for example. So I think adding a project to the technical agenda to address the indexation guidance is warranted, and it is responsive to the comments that we received. I agree that such a project meets the agenda criteria. The staff is addressing what stakeholders have indicated is the most problematic area and complex and costly. Removing the fixed for fixed assessment would represent a significant improvement in reducing complexity and costs. In fact, it's my understanding that contracts rarely have completely fixed terms. And the fixed for fixed assessment depends on the identification of extraneous variables and the distinction between those variables as being acceptable and unacceptable is not always clear. So there's an opportunity there. It's also my understanding that the hybrid contract provisions often include variables that are tied to revenue and EBITDA metrics, and that may cause the indexation test to fail, which many view in those circumstances that that may not be economic intuition, if you will. So here, the indexation guidance, I think the proposals that you've made, I think could address many concerns that could spill into having financial statements that depict the economics more succinctly. However, I am interested in a separate longer-term research effort to address liabilities and equity outside of the scope of the indexation guidance, specifically as it relates to settlement provisions that focus on form rather than the economic substance. And I think in this effort, perhaps obtaining extensive input from preparers to fully understand more about the challenges in applying guidance as it pertains to those settlement provisions. So for example, a review of the settlement guidance as it pertains to cash settlement clauses, where, for example, the instrument may be classified as a liability because of some remote contingent cash settlement provision, when a fuller analysis and assessment of the provisions may indicate that the instrument will certainly settle in shares. So looking at that, in addition to the economic effectiveness of the outcomes of the assessment of whether settlement terms are within the issuer's control. I think even when there's a change in control event that's unlikely, the possibility alone can cause the conversion feature to meet the liability classification. Again, is that an economic depiction of that particular instrument? So these settlement analyses, I think, focus on contractual rights rather than on the probability of the occurrence of the event. And I appreciate the work that you've done in terms of analyzing whether or not, it is feasible to write guidance that includes those types of features. But I think that we perhaps could do a little more research, talk to preparers, and perhaps fully understand if there's an opportunity there, given the multi-layered settlement decision process, where in some cases, they overturn the indexation decision. And here today, we are proposing indexation guidance that could be more economically sound. And therefore, we perhaps have research opportunities to reduce the extent to which preparers are looking at incremental guidance that at the end of the day, overrules this perhaps more effective assessment of whether it's a liability or an equity based on the indexation guidance. So where are there, form over substance opportunities? In addition, I do think that there's an opportunity to work with the SEC regarding the mezzanine equity guidance. I think that the guidance currently adds further complexity by introducing a third potential classification category. It causes investors to make adjustments as they try to deal with comparability challenges between public companies and public companies that have peer private issuers. It also adds an additional evaluation assessment for preparers. So I think ideally we could address some sort of uniformity in the instruments that are classified in the temporary equity category under the SEC guidance with gap guidance pretty much to help simplify and lessen the complexity for stakeholders. Regarding question 3, in the board memo, I guess the staff noted a potential objective that the project would result in more instruments being considered indexed to an entity's own equity. I view that as a potential consequence or outcome of this extensive work that you all are doing. I do think that there is an opportunity, however, to add an objective similar to what Sue has mentioned regarding transparency, if you will. You have mentioned that you are going to pursue further work in disclosures as part of the potential project to benefit investors. I think that based on the research thus far, we've learned that users perform their own analysis and they adjust gap information based on their own assessment of the substance of the contractual obligations within these hybrid transactions. Equity analysts and credit analysts each may have different viewpoints with gap, and they have different viewpoints amongst themselves as to how they may treat these hybrid instruments. So I think that we should certainly take up an effort to learn whether or not we are providing the most robust information for their decision making. We've heard from our investor advisory committee that it's more important to obtain information about the instrument. We've heard from our FASAC advisory council that they'd like to better understand the nature and the terms of the instrument. So I do think that we have an opportunity to provide investors with information to help them reconstruct the capital structure, which is what they're doing today, so that they can avail themselves with better information to adjust capital and their leverage metrics.
Okay, thanks, Joyce. Marcia.
So we have a rather large group of members on this staff team, and I want to thank you. And I think that's reflective of the effort that's involved in trying to deal with an issue that can be this complex. Thank you for all the work you've done. I know I've been at this table for a number of years where versions of a project to address this have been presented. We've had trouble coming up with a feasible solution, or we may have had some stakeholders that felt that strongly about outcomes. So thank you for all the work you've done. And I just talk about the fact that I appreciate that this has been a heavy lift, but I am really thrilled to support you. I am thrilled that you've been able to bring us something that is technically feasible. And I think it's been worth all the effort and time that you've put into it to be at this stage. So yes, I am supportive in doing something. You analyzed 3 areas in the guidance. You're recommending that we deal with the indexation guidance. I know we're going to talk about approaches to that in the subsequent questions, but I I think you made the right analysis there. Again, because I think as I looked through all of the feedback we received about all of these areas of guidance that touch on relevant aspects, I think you're focused on what's achievable. And after the years of talking about this area, I'd like to see us get success. So I think you've made the right decision that the scope of this be with regards to indexation. On question 3, with regards to the objective, we often have projects that are focused on costly, let's make something less costly, let's make something complex more simple. We don't always have a project that we know going in that the outcomes are going to be different. When we're doing a project like crypto where there's no guidance, we know that we're helping people go and define what the outcome is going to be. In this case, I think it's unusual that we have an outcome that's defined as an objective, but I think I understand what you're trying to say. And I know that we've had a number of projects where we've been clear that we don't necessarily expect changes in outcomes, and we're trying to address complexity. And in this case, I think it is appropriate that we acknowledge this has been a difficult topic and it's complex, and changes in outcomes are likely to result. So we shouldn't let a change in the outcome prevent us from moving forward and finalizing something. So I think that's what you're trying to message with that particular objective, even though I would acknowledge it is unusual to have a consequence, as Joyce said, a consequence or the byproduct of the updated guidance identified as a conclusion, but I appreciate what you're trying to say. So I think that's it for now, and I'll hold my comments on approach for later.
Thanks, Marcia. Christine?
So with respect to question 1, when I began my time as a board member in 2016, we issued an agenda consultation within months of my beginning as a board member. And that ITC said, quote, stakeholders find the guidance to be, and it was talking about liabilities and equity guidance, to be internally inconsistent, conceptually flawed, rules-based, and subject to financial structuring to achieve a desired result, and creating many instances of restatements. So now as I end my time as a board member, I think we can still describe the guidance as internally inconsistent, conceptually flawed, rule-based, and subject to financial structuring. So I do think that there is a problem in this area. I think it's pervasive. I think we do need to improve gap in this area. And I've always believed that there was a solution to the problem. So I do support adding a project to the agenda. Now on question number 2, I would not limit the project to issue A, the indexation guidance, because if we address the indexation guidance, but we don't address the settlement guidance, I'm not convinced that those changes are going to justify the cost of the change. Because under the proposed path, uneconomic outcomes will still continue to be a common problem, in my view. When I looked at the 14 examples that the staff provided us in the materials, uneconomic outcomes will continue to be possible in all 14 cases if the board addresses only issue A in the manner that that is being proposed. So I believe that the fundamental problem with the guidance is that it distinguishes between liabilities and equity claims using a variety of characteristics. So if we just look at topic 480, it identifies some liabilities based on timing of settlement. It identifies other liabilities based on form of settlement, and still other liabilities based on a lack of indexation. And topic 815 uses both indexation and form of settlement to distinguish classification. That ignores the fact, in my opinion, that it is mathematically impossible to separate a group of items into 2 buckets, and we only have 2, liability or equity, using more than one characteristic. A clean separation of claims will only be possible if the board chooses one characteristic and then applies it consistently. And the one thing that can be supported economically is whether or not the settlement value is indexed to the value of the entity. So I would take on a holistic project to improve indexation and do away with settlement. In broad brushstrokes, the solution would classify a claim as equity if the settlement amount is likely to depend on the value of the entity, and if not, then the claim would be classified as a liability. Claims that could contingently settle as an equity or liability claim would be subject to a probability assessment to determine the likely outcome and classified accordingly. And disclosure and presentation requirements would be revised to ensure that necessary information about form and timing of settlement is conveyed to investors. So in terms of the objective for the project, obviously that would be a very different objective than what is being proposed by the staff. The objective of that project would be to make the guidance more internally consistent, more representationally faithful of the economic difference between residual and non-residual claims, and less subject to financial structuring.
Okay. Thanks, Christine. Fred?
Thanks. And I think it's clear from the discussion that liabilities and equity is an evergreen project for the FASB. And I think in that regard, I think I do support kind of a near-term project that the staff is recommending relative to indexation. I think it does address some of the issues that have been raised in the ITC. But I would also hope that we could structure this a bit more like we're doing hedging, with both a short-term project and also what I would consider more intermediate-term projects. I think that other board members have recommended. I think that includes looking at cash settlements and its interactions with indexation, as Christina suggested. I think that looking at indexation in isolation can potentially get us some progress, but won't be a broad base. Secondly, I think that Joyce had mentioned a number of issues, and I also that I think investors are focused on, and I would thank the staff for especially the feedback that we got, from investors on this issue. From my own standpoint, I think the equity accounts aren't helpful today for investors, and they're difficult for auditors and preparers. And that, what I mean by that is the classification between other paid-in capital and retained earnings and the other equity classifications. Today, investors tend to just lump those all together. And while there's time spent trying to differentiate those. So I think that we could revisit those accounts and make them much more meaningful to investors, including, as Joyce had suggested, something where we have some kind of mezzanine equity accounts that interact with, and we'd have to work with SEC. Finally, as was suggested, I think on liabilities, one of the big pressure points that we have today is the liability classification when we get fair value marks through income. And I think, as was said, that's not those marks and that income effect have not been proven to be useful for investors. So I think a relook at that on the liability side could be helpful, and it could take some of the pressure that we see today in terms of liability equity classification and reduce that. So I do support the near-term project that's being recommended, but I also would try to format a intermediate-term project for us to look at the issue more broadly. I think others have addressed question 3, and I think I'm fine with the way that I think Marcia had characterized it. That we just need to recognize, while the goal may not be an outcome, we do need to recognize what the outcome likely will be, and I think that is helpful. Thanks.
Thanks, Fred. Hillary?
I appreciate all of the feedback from our stakeholders over time, as well as for our staff for kind of accumulating that, and importantly, going back to our stakeholders, because I think this is an area we continue to hear that the guidance is complex. the resulting accounting may not be intuitive, and it may not be providing decision useful information to investors. We've heard that consistently over time. But what I think the difference is we're now hearing that willingness from a stakeholder perspective to, in my view, kind of listen to investors and think about whether more things in equity is actually providing more decision useful information. So I think that that's a really great kind of change in perspectives that we're hearing, which I think is really opening the door for us to make significant, meaningful improvement in this area. So I am certainly supportive of adding this project to the agenda. Now, when it comes to which of the areas to address, and I know you guys went through the comprehensive challenges associated with all the different areas of the guidance for liability and equity, I do think we have heard mixed feedback with regards to folks would like us to address this more broadly, like us to address indexation and settlement at the same time. And I appreciate all of that feedback. And I think in a perfect world, I'd absolutely love to put a more comprehensive project on the agenda and address this all at once. But I do think what we have heard at a minimum is that indexation needs to be addressed and needs to be addressed fairly quickly. Right. From this perspective, we've seen lots of recent challenges in having to apply the existing guidance to share settled instruments, resulting in unintuitive accounting outcomes, resulting in restatements, and things that I think investors didn't necessarily think were providing decision useful information for the, for financial statements to be restated associated with the classification of these instruments. So I do think that this is absolutely imperative that we address the existing practice issues associated with indexation and really being clear about what instruments are indexed to the company's own stock. So I do think we do have that opportunity now. Well, I do absolutely believe that in the future we should be addressing settlement. And I agree with Fred and Joyce and others that, share an interest in potentially looking at presentation, whether or not there is a need for mezzanine equity in the future, whether or not we need to think about what the measurement of that should be and whether it would be consistent with the SEC guidance today. I do think that those are some broader issues for us to potentially look at, but I wouldn't include it as part of this project today. I would have been interested in including settlement in this project if the proposed solutions for addressing the settlement issues would have been addressed by a similar proposed solution as we're including for indexation. But I think we kind of have a divergence there with regards to the approaches. So I think it is best to really focus on indexation, make meaningful improvement with regards to that. And I actually think that that will address a significant number of existing practice issues. It won't address them all. That's absolutely, truthful, but it will address a lot of the challenges that are out there for preparers to apply, for practitioners to, audit, and for regulators to regulate. And I think that's a really important part of this project. So certainly very supportive of this project. When it comes to the objective, so question 3, I certainly agree with the staff recommendation to, objective should be to make the guidance less complex, reduce inconsistent application and interpretation. I do think the outcome of that is that the accounting outcome will change. I don't necessarily believe that needs to be part of the objective of the project, but I do think that's a natural outcome associated with that objective.
Great. So I do want to also thank our team and thank all the stakeholders who spent time with our team over the last several months as we've been working on, is there a project here? Rightly or wrongly, we have 3 categories on the balance sheet, right? We have assets, liabilities, and equity. Unfortunately, again, 2 of them are on the same side, right? So we've got to draw a line between them, and it really matters. When I step back and I say, well, what's different about this time versus the prior times that either when I've been on the board or I've seen the board attempt to deal with this, I actually think it was the importance of the investor input, where they effectively said when they understood some of the items that were classified as liabilities that they really didn't want those messing up their income statement. It didn't mean they didn't want transparency on liquidity, which we'll talk about a little later. But it was very challenging for them to undo those income statement effects. And by the way, undoing the income statement effects doesn't sound like it's very good accounting. It sounds like accounting you would have preferred a different answer. I think that's different. And I also think there was probably more of a practitioner willingness to accept more in equity and recognizing that was how we were going to not only meet the needs of investors, but it was the only way we were going to actually reduce some of the complexity in this project. And I think that's different. I think those two items. So the missing item from there is the preparers, and I'd be remiss if I didn't comment that, I always felt bad for the preparers in this space because chances are they had a one-off transaction. They had to hire a specialist. They had a couple investment bankers, and they were just along for the ride. And I don't think that's really, really good. And I think anything that we can do to help make this so that the people preparing those financial statements can make their own analysis and reach an accounting conclusion is helpful. So I certainly support adding the project. As far as indexation versus other items, I do think that solving the indexation issue, let's say that's our objective, solving the indexation issue, certainly is a good goal, and I think we have a framework to do that. The issue of probable on settlement, I must admit at one point in time I thought that was the way to do it. But I don't think we've brought our stakeholders along to the point where we can make that a feasible solution. I think some of them are willing to go there. I think others aren't. I think what would happen, unfortunately, in practice, if we pursued that right now, is there'd be a list of items that can be considered probable, a list that can't be, and it would be consistently second guessed. And I don't think that changing poor accounting benefits any of our stakeholders. And when I say poor accounting, I mean accounting that someone does and someone then decides it was an error after the fact. I think probable works really well in a lot of areas. Could it work here eventually? Maybe, but I think we have to bring particularly our practitioner stakeholders along on that and our regulator stakeholder along on that to make sure that it's clear and that reasonable judgments would be respected. And I'm not sure we're there yet. I certainly hear the comments from my fellow board members that there's other things they'd like to look at, whether it's the SEC who decided to segment equity and then create actually accounting different outcomes, even though, when I think of segmenting equity, I think we do that today, right? We have common stock, preferred stock, those segmentations make sense. Mezzanine, I get it if you want to call that another classification of equity, but then when you have carry-on accounting consequences, that's where I don't get it. If that's fair game, maybe that's something that the board could consider in the future. I think that, as well as other items, is I agree with Fred's characterization. This is let's call it the project that we've added today on indexation makes sense to pursue. Doesn't mean that the board can't consider some of those broader things in a separate project at some point in the future. I would suggest see how we do on this a little bit first before you really delve into that. Because if we fail here, I'm not really optimistic on the others. And then as far as the objective of the project, I do think one of the objectives we heard clearly from investors is we have things and liabilities that don't belong there. And moving them when they're based on these indexation characteristics back to equity makes sense. So I'm not bothered by that. And I think actually that acknowledgement of more things belong in equity was a key driver of, let's say, of our success so far. I won't prejudge the outcome, but our success so far with stakeholders. So whether it's in the objective or not, I think let's put it this way, if it's not the result, we should probably drop it today. So I would agree with that. I don't mind it being removed from the objective. So with that, agree with the staff recommendations on 1 through 3. And with that, let me turn it back to our team to move us on to question 4.
Thanks, Rich. I'll now tee up our analysis of indexation approaches and recommendations. The staff has identified 3 approaches for the board's consideration to improve the indexation guidance: the at least in part approach, the extraneous approach, and the acceptable variables approach, which are described in detail in paragraph 19 of the handout. The at least in part approach would result in the broadest view of equity, be easy to apply, and address current practice issues. However, based on outreach and further analysis, the staff is concerned that it would be too significant of a change from current guidance and therefore may not receive sufficient stakeholder support. The extraneous approach and acceptable variables approach would be intended to result in similar indexation outcomes, but would require a different level of judgment. While the extraneous approach would require judgment to determine what is extraneous, the acceptable variables approach would minimize the use of judgment. The staff thinks the extraneous approach could result in inconsistent interpretation and therefore may not resolve current practice issues because of the subjective nature of the extraneous threshold and because it is already included in current guidance. Furthermore, the acceptable variables approach would primarily retain the acceptable variables included in current guidance and not introduce any new thresholds, which the staff thinks would help with implementation. The staff recommends that the board pursue the acceptable variables approach. The staff thinks that this approach is the most technically feasible solution of all the approaches and that it would maximize expected benefits and minimize expected costs of the change and be responsive to stakeholder feedback and address current practice issues. Additionally, given the pressing nature of the challenges with the indexation guidance, because the acceptable variables approach would make less changes to current guidance as compared with the at least in part and extraneous approaches, the staff thinks that the improvements could be made in an efficient and timely manner. In considering the intention of the acceptable variables approach and the project's objectives, this approach would address the current practice issues around leverage factors by explicitly specifying that A, any adjustments that relate to the specified acceptable variables would not preclude an instrument from being considered indexed, and B, any adjustments that do not relate to the specified acceptable variables would preclude an instrument from being considered indexed. The staff thinks that if the specified acceptable variables are those that the board thinks should permit indexation, any amount of those variables should be acceptable. This approach would focus on the nature of the adjustments rather than the extent or amount of the adjustment. Therefore, the staff thinks that this approach would directly address current practice issues around leverage, given that it allows all leverage as long as it relates to a specified acceptable variable without adding cost and complexity. As far as next steps, if the board agrees with the staff recommendation on indexation, the staff plans to perform investor outreach related to disclosures for equity classified contracts. After that, the staff will provide analysis and recommendations at a future meeting on consequential amendments, disclosures, transition, and expected costs and benefits. And with that, I'll hand it back to Rich for discussion on questions 4 and 5.
Okay, any questions for the staff on 4 and 5? Christine?
So when I look at the at least in part approach and the acceptable variables approach at a really high level, it seems like the acceptable variables approach is going to add the entity's own operations or activities to step 2. It's going to keep step 1. Whereas the at least in part approach would also add considering an entity's own operations or activities to step 2, but then it would combine step 2 and step 1. So I was trying to figure out to what extent the staff would anticipate that those two approaches would get us to significantly different outcomes. When I look at the 14 examples that you all prepared, there were only 2 instances where it got to different answers. So I'm just wondering does the staff have a sense of how often those, or just a sense of the magnitude of the difference, I guess, in outcomes, not in the change to the guidance, but in outcomes.
Yeah, thanks, Christine. I can answer that. I think because the at least in part just says that it has to be just based at least in part on the operations activities or stock price, we think that is pretty broad. Like it's just at least in part, right? It could be like 90% based on the price of gold and just 5% based on the rest. I think the acceptable variables approach would disallow that. So if something was based on the price of gold, for example, that wouldn't be in the list of acceptable variables. So that would be out. And that is the difference between them.
Okay, any other questions? All right, not seeing any. Sue?
Thanks, Rich. So I wanted to focus on step 2 of the indexation approach. I think that's where we've gotten the most feedback. And, you know, when they put that fixed for fixed assessment back in and it was 7.5 and it's codified in 8.15.40, you know, there were so many examples that were added to that because it wasn't intuitive and there's just there. I remember the discussions at the time where there was just outcomes in mind and it just doesn't translate and stand the test of time. So for me, I want to focus on step 2. And so the at least in part approach is step 1 and step 2. So I wouldn't focus on that one. I think it's too broad, as you point out, and based on the response you gave to Christine in her question. So the other 2 approaches are really focused on step 2. And I do like the acceptable variables approach. I think that, you know, my initial thought was, oh gosh, another list in the codification. But as I got more familiar with it, I think it's not necessarily a list that's going to change as we have in other places in the codification. And so I think it would be operable. And I do think that it eliminates that fixed for fixed assessment that we've struggled with for just years. I don't like the extraneous approach. I think it perhaps, as you point out in the research, that it could lead to a quantitative analysis. We'd have to define extraneous. There's some drawbacks to it, I think. And so therefore I would support the staff recommendation.
Okay, thanks, Sue. Joyce?
So I also support the staff recommendation. I think the acceptable variables approach would provide the most improvement to the indexation guidance. The at least in part approach is favorable because it's a single model. However, I don't think it's enough of a screen, if you will, to evaluate the substance of the hybrid financial instruments. The approach would not sufficiently consider the factors and variables that evaluate how sensitive the contract is to the index, given the lack of specificity around the variables. Regarding the extraneous approach, once again, given the importance of evaluating the variables, I think the subjectivity that's applied in determining that population would present a greater challenge. It will reflect greater diversity in the variable analysis than the acceptable variables approach, which I support. And of course, the staff has mentioned that the practice today currently experiences challenges in the application of the extraneous notion. So I support the acceptable variable approach. I appreciate the specific identification of the comprehensive variables. With that, there's likely a greater potential that similar instruments will be accounted for in a similar fashion because of that very specifically identified set of variables. And those variables are in line with how the market thinks about instruments. So they're certainly relevant. And I would also add that you have identified certain variables that you think may warrant greater clarity. And I appreciate your potential analysis of those variables to determine whether or not we may need to have incremental descriptive enhancements around the definitions of those variables. Clearly, some are in application today, some are well understood, but because of the importance of that population, I appreciate your intent of looking at certain variables and determining whether or not it needs more clarity.
Okay, thanks, Joyce. Marcia?
So I appreciate the alternatives that you brought to us, and I read them in the order, and I wanted very much a solution. So I'm reading the first approach, the at least in part approach, and as I'm reading through it, I'm thinking, well, this is good. It's few words in the codification, so in theory, often not always true, but you think the fewer words, the less misinterpretation there could be. And then I liked the idea of combining step 1 and step 2. And I said, if we're going to do this, let's go bold. Then as I continued to read your alternatives, I felt that the extraneous approach, as you defined it, required too much judgment and wasn't going to achieve, be as usable a solution as some of the others. And without a doubt, they all three were meeting the objective, which I think is definitely an improvement of removing the fixed for fixed evaluation. So I read through your analysis. You convinced me. The extra words in the variables approach is still helpful. In defining what those variables are, you're using terminology that is primarily well understood today, so we should have less risk of a misinterpretation. Walk before you run is often what we hear, and I think you've brought us a project with a recommended approach that gets us on the right path. So I'm comfortable supporting where you were.
Okay. Thanks, Marcia. Christine?
So I would support further work on both the at least in part approach and the acceptable variables approach. When I looked at the outcomes, as I indicated when I asked my question initially, they seem to generally arrive at the same conclusions, except in a handful of cases. And in the 2 cases where the conclusions were different, which was a warrant issued in a SPAC transaction and a variability involving a commodity price, which is the example that you gave, Erica. In my view, both of those should be equity classified. So having them get kicked out of indexation to me will result in them not being properly classified. So that's why I would take another look at that at least in part approach. Now, I am concerned that, 14 cases is not all cases. So what are the unintended consequences? Potentially, I don't feel like I have enough understanding of that. And so that's why I would continue to do work on both of those. Were we also supposed to address question 5 at this point? Yeah, okay. So on question 5, regarding the plan's next, the staff's next steps. I agree with the plan, but I do think that it would be important for us to perform outreach with investors on classification outcomes that might change or that would change. So if we are aware of, let's say, common or reasonably common types of instruments where the classification will change, I think it would be important for us to at least get some feedback from investors as to whether they're comfortable with those changes or not.
Okay, thanks, Christine. Fred?
Thanks. I also appreciate the staff input on this. In my discussions, I think I came to the point, as other board members said, that the acceptable variables approach is the most efficacious and most straightforward way to address this issue. Like Sue, I was concerned about keeping up a list, but I think in terms of this, it isn't really a list that necessarily needs to be maintained, because really it is a number of fairly open-ended acceptable variables. So I think it can work in addressing this narrow fact circumstances. So I do support the staff recommendation on this. Like Christine, I would agree that I think some outreach with investors when we are going to see different classifications, especially things moving into equity, make sure that they will be receiving the information they need to fully address this could be helpful in terms of next steps. Thanks.
Thanks, Fred. Hillary?
I will reiterate my thanks to the staff and to all the different stakeholders who we went through a number of different approaches, and appreciate that, there are multiple iterations of those, and I think you've ended up with potential solutions that are viable. But I do agree that the acceptable variables approach seems like the approach that we should be moving forward with. I think it does strike the right balance because it is based on the most operable parts of our existing index or our existing guidance, but it eliminates some of the complexities, I think, in describing what that guidance is intended to do. And I think it's going to reduce judgment, which I think is a really important part of this exercise. I think that's going to really help reduce some of the friction that exists associated with how we come to these conclusions. I do think those are important simplifications to make. I do think including an entity's own activities or operations is really key, right, to addressing some of the practice issues that we've seen today. And I do think that I kind of paused when we started talking about leverage features, as the staff is aware, right? Thinking about those, this has always been a practice issue, right? With regards to what is leverage, what amount of leverage is okay before you say that something is not considered to be indexed to the company's own stock. And I really appreciate all of the work that the staff did and in talking with stakeholders with regards to could we find a feasible solution to address the you know it when you see it perspective with regards to leverage. And I also appreciate the fact that many of the conversations we have about leverage are probably more hypothetical, right? They're not necessarily features that we see in these type of instruments today, but trying to future-proof the guidance from an anti-abuse perspective. Certainly, I think as we've kind of walked through that exercise, the idea that the staff have with regards to leverage would not preclude you from saying you're indexed to the company's own stock as long as it's associated with the variables that are on the acceptable variable list, I think is a fair way to address the issue. I will say I still personally have a little bit of concern with regards to when it's inverse, when the direction is opposite, right? If you have something where the settlement feature varies inverse with the entity's stock price, like an inverse floater, I think I have a little bit of conceptual concern with that, but I also don't necessarily have a practical concern that that feature is out there in practice. But I do think it could be interesting in talking with investors is there any kind of leverage they are concerned about, right? That we need to make sure that that is reflected as part of the model. But I do think that the way I support the way that the staff has, suggested we move forward from a leverage perspective, especially in the context of the fact that we do have guardrails, right? We still have other guidance that has to be applied on top of this specific guidance. With regards to the other approaches, and maybe just a comment on the extraneous approach, I do think that that approach has some, I would say people be interested in that approach, right? We kind of know what every individual believes they know what extraneous means. I think the challenge is that might be different for every single individual who's looking at the guidance, right? And I think that where it may be seen as being a more simple solution, I think there's a lot of judgment involved in that. And I don't think that investors really benefit from that personal judgment of what's extraneous or not. I also don't want to get into some of the same issues that we get into today with regards to how something is calculated. Is that calculated in a way that's consistent with a fixed for fixed option pricing model? Is that done in a commercially reasonable way? All of those things, I think, come into thinking about whether or not it would be extraneous. And I think we know there are perspectives that are different with regards to those. So I do think moving away from that, I think we kind of get to a similar concept with the acceptable variables, which is if it's anything that's not an acceptable variable, it's extraneous, right? So I think that that's the way I would kind of think about it. But certainly I think the acceptable variable approach, again, maximizing the operable aspects of the existing guidance and reducing judgment will improve consistency and I think improve the financial reporting result. Oh, Rich, sorry, one other thing. Apologies on planned next steps. One of the things I think the staff had mentioned was whether we need to further describe those acceptable variables in GAAP, whether we need to, go back and kind of look at, do we know what those things mean? Is that something that can be applied from a consistent perspective? I would just put out my own perspective there that those variables have been being applied in practice for almost 20 years at this point. We don't currently have definitions of all of them in GAAP. I would be hesitant to try and define those variables. I think we could get ourselves into a situation where we actually would introduce significantly more complexity than We would if we don't have to define them, and I don't think it's necessary. I think based on a lot of our outreach, right, we know what those variables are. It's not that there's misunderstandings about whether or not you are one of those variables. The misunderstandings or the diversity in practice was more of, were there certain calculation changes? Were those considered to be leverage features? So I don't think that we necessarily need to address those to address the practice issues that exist today. Thank you.
Done. So maybe just to close us out. So I am supportive of pursuing the acceptable variables approach. And I acknowledge as we did the outreach, there were some who were very supportive of an extraneous approach. And I do think it's worth, as they provide us feedback as part of the ongoing journey that we'll be on this, if there's anything that's not extraneous that they think should be on the list, I think that might be one way of pursuing it. I struggled with extraneous just because the definition is something irrelevant, unnecessary, or coming from the outside. My guess is we all have different views on what's unnecessary and sometimes irrelevant. And particularly in this context, I recognize people have their definitions in other areas, but I think that would be continued added complexity. And one of the things we're trying to do is reduce complexity. And one of my objective is to make it clear for anyone with an instrument, whether it passes or fails. The list does have challenges. I know in the past where we've had lists, somebody wants something added to the list. I'm hoping that the entity's own operations or activities will suffice. So I'm supportive of pursuing solely the acceptable variables approach. When it comes to next steps, in our outreach with stakeholders, disclosures, I do think anytime we have something in equity where there's a potential liquidity event, the terms of that event and the amount of the liquidity, those are really important. And there's no doubt about it. I think that's got to be something that's there in a disclosure perspective. I think if you do identify any common instruments where the classification is changing, a necessary part of that discussion is with these disclosures. Because I think there's a difference between asking someone, do you mind that this is no longer a liability, it's going to be an equity, with them understanding in equity, by the way, you get all this information. And I think that's got to be a fulsome discussion. So with that, I do want to thank our team, thank all the stakeholders who helped us, and looking forward to seeing you at a future board meeting. So with that, I believe that concludes today's board meeting. Thanks, everyone.